Something has changed in the global financial system, and it didn't arrive with a crisis headline or a dramatic collapse. It arrived quietly, through a sequence of small, orderly decisions that most people ignored because nothing appeared to be breaking. Markets kept functioning. Bond auctions cleared. Interest rates moved, but not violently. On the surface, the system looked stable. But stability can be deceptive when it's maintained by habit rather than conviction. For decades, one assumption anchored the modern financial world: when uncertainty rises, capital flows into U.S. government debt. It's treated as the final refuge, the asset that remains standing when everything else wobbles. That assumption shaped central bank behavior, reserve management, trade settlement, and even geopolitical strategy. It was never written into law, but it governed outcomes all the same. That assumption is now eroding. Not through a single event. Not through panic selling. And not through political theater. The shift is happening through absence. Through what is no longer being renewed. Through positions that quietly mature and are not replaced. Through balance sheets that shrink not because of distress, but because of intention. What makes this moment difficult to recognize is that nothing looks dramatic yet. Yields are not exploding. The dollar still trades. Treasuries still find buyers. On paper, everything functions. But the behavior underneath has changed, and once behavior changes, outcomes follow with a delay. In recent years, one of the largest participants in the Treasury market has steadily reduced its exposure, not in response to market stress, but in response to arithmetic. The reductions did not occur all at once. They were spread across years. Spread across maturities. Spread across reporting cycles. That's why they were easy to dismiss as noise. But noise doesn't persist in one direction for this long. What matters here is not the monthly figure or the headline number. What matters is the direction, the consistency, and the absence of reversal. When an institution with decades of experience managing foreign reserves changes course and stays on that path regardless of short-term market conditions, it is signaling a reassessment of risk that goes far beyond politics or trade disputes. At this stage, the reasons are not being announced loudly. They don't need to be. The actions themselves carry the message. A system built on continuous rollover depends on confidence that tomorrow will resemble yesterday. When that confidence weakens, the system does not fail immediately. It adapts. It stretches. And then, eventually, it encounters limits it cannot negotiate with. What you are watching now is not a reaction. It is preparation. And preparation always happens before disruption becomes visible. The question is not why this is happening yet. The more important question is why it's being done so quietly. When large financial shifts occur, people expect movement in prices. They expect volatility, disorder, and visible stress. But the most consequential reallocations rarely announce themselves that way. They happen through mechanics that look boring unless you understand what they imply over time. In this case, the reduction is not driven by aggressive selling. There are no waves of bonds being dumped onto the market. No sudden spikes in yields. No signals that would force other participants to react defensively. Instead, the process unfolds through maturity. Bonds expire. Principal is returned. And the proceeds are simply not reinvested. This matters because modern sovereign debt markets are built around constant renewal. Governments do not pay down debt in the traditional sense. They refinance it. Old obligations are replaced with new ones. The system works as long as participants remain willing to roll their exposure forward indefinitely. When that willingness fades, even gradually, the structure begins to thin. By allowing holdings to run off naturally, exposure declines without disrupting prices. It is the least visible way to exit a position, and it is precisely how experienced reserve managers behave when they want to reduce risk without triggering feedback loops. Nothing breaks. But something changes. Over time, the cumulative effect becomes impossible to ignore. Holdings that once sat comfortably above $1 trillion fall below that threshold and never return. Annual reductions repeat year after year. The pattern holds regardless of interest rate cycles, geopolitical events, or market rallies. That consistency is the signal. Some analysts argue that official numbers understate true exposure, pointing to custodial accounts and offshore intermediaries. It's possible that some holdings are masked by structure rather than eliminated entirely. But even that argument reinforces the core point. If confidence were intact, there would be no reason to obscure ownership or complicate reporting. Complexity is introduced when exits must be managed delicately. What's important here is not whether exposure has fallen by a specific percentage, but that concentration is being reduced across the system. Whether through central banks, state institutions, or affiliated entities, the direction is the same. Less reliance on one form of asset. More dispersion into others. This is not a trade. It is not a tactical move to capture yield. It is balance sheet risk management in response to constraints that cannot be solved by policy statements or rate adjustments. And once institutions reach that conclusion, they do not reverse course easily. The absence of drama is what makes this phase dangerous. When exits are slow and orderly, they attract little attention. But they also mean that when stress finally appears, the margin for adjustment is already gone. The system still functions. But it now functions with less tolerance for shock. And that distinction will matter later. At first glance, the data appears contradictory. While one major participant steadily reduces exposure, total foreign ownership of U.S. government debt continues to rise. Holdings reach record levels. New buyers appear. Headlines suggest resilience. To many observers, this looks like confirmation that concerns are overblown. That interpretation misunderstands the difference between choice and necessity. Not all buyers participate in the Treasury market for the same reasons. Some accumulate dollars through trade surpluses and must deploy them somewhere. Others manage currency pegs, banking systems, or financial centers that require dollar liquidity regardless of valuation. For these participants, buying U.S. debt is not a vote of confidence. It is a structural requirement. When an economy depends on exports priced in dollars, reserves grow whether policymakers want them to or not. When banks operate at the center of global dollar flows, balance sheets must match dollar liabilities with dollar assets. These dynamics force participation even when returns are unattractive and risks are rising. That is fundamentally different from a strategic buyer choosing to reduce exposure despite opportunity costs. When forced buyers dominate demand, prices can remain stable longer than fundamentals suggest. But stability under compulsion is fragile. It depends on relationships that can change. Trade balances shift. Energy flows realign. Financial centers lose dominance. When those structures weaken, forced buyers become reluctant buyers, and then sellers. The presence of continued demand does not negate the significance of a strategic exit. In fact, it amplifies it. It shows that some participants are constrained, while others are adapting in advance. This distinction explains why the market appears calm while its foundation thins. Yield levels reflect today's demand, not tomorrow's willingness. Risk is not priced by those who cannot exit. It is signaled by those who can. The contradiction resolves once you recognize that the market is being supported by necessity rather than belief. And markets supported by necessity do not fail gradually. They hold together until the supporting structure shifts, and then adjustment happens quickly. This is why the behavior of unconstrained actors matters more than aggregate totals. They reveal how risk is being assessed without political filters or public messaging. Their actions reflect internal models, not narratives. For now, the system absorbs the change. But absorption has limits. And those limits are mathematical, not political. Once you view this shift through constraints rather than intentions, the likely sequence becomes clearer. Not as a prediction tied to dates, but as a progression driven by necessity. Government debt does not stabilize itself. It requires continuous refinancing. When deficits persist, new issuance must cover both spending and existing obligations. As total debt grows, so do interest costs. Rising interest costs increase deficits. That feedback loop tightens over time. As long as demand remains elastic, the system adjusts. When elasticity declines, pressure builds. Yields must rise to attract buyers. Higher yields increase servicing costs. That forces either spending cuts, higher taxes, or monetary intervention. History shows which option is chosen most often. Monetary authorities cannot allow disorderly funding conditions for sovereign debt. When private and foreign demand weakens, central banks step in. They expand balance sheets to absorb supply. They do this not because it's optimal, but because the alternative is worse. This intervention does not immediately cause collapse. It preserves functionality. But it shifts the burden from bond markets to currency value. Inflation becomes the release valve. Purchasing power absorbs the adjustment that yields cannot. In previous cycles, this process unfolded alongside global coordination. When every major currency expanded together, relative values remained stable. Today, conditions are diverging. Some systems tighten. Others pause. That divergence matters. When monetary expansion becomes isolated rather than shared, the currency absorbs the strain more directly. This does not require hyperinflation. It requires persistence. Small erosions, compounded over time, reshape behavior, savings, and investment decisions. This sequence is not theoretical. Variations of it have appeared repeatedly across monetary history. Different countries. Different decades. Same constraints. The names change. The mechanics do not. What you are seeing now is the early phase, where preparation replaces assumption. Where exposure declines before justification becomes obvious. Where the system still works, but less smoothly than before. The later stages do not announce themselves politely. They arrive when adjustment can no longer be delayed. In the end, all financial systems confront the same boundary. They can rearrange claims. They can abstract value. They can postpone recognition. But they cannot escape physical and economic limits. Money is a claim on output. Debt is a claim on future production. When claims grow faster than the capacity to honor them, the system adapts by reducing the real value of those claims. This is not a moral judgment. It is arithmetic. What makes the current moment distinctive is not that debt is high. It is that confidence in perpetual rollover is weakening among those with the greatest flexibility to act. When long-term participants reduce exposure despite short-term stability, they are acknowledging that the system's margin for error has narrowed. This is not about collapse tomorrow. It is about direction today. About recognizing when a framework that worked for decades no longer scales cleanly into the future. Institutions can manage perception. They cannot negotiate with math. This analysis is not financial advice. It is an examination of constraints and behavior. Markets will continue to function. Governments will continue to operate. But the conditions that supported past stability are changing, and change does not require drama to be real. History rarely repeats in appearance. It repeats in structure. When confidence shifts before prices do, those shifts tend to matter most. They shape outcomes long before headlines catch up. And by the time explanations become common, adjustment is already underway. What remains now is not uncertainty about whether the system can continue, but clarity about how it will adapt. And adaptation, once forced, is never optional.